If trading success relies entirely on discipline and risk management, military soldiers would rule Wall Street. Yet highly disciplined professionals systematically wipe out their accounts. To understand why, we have to define exactly what success looks like in the financial markets. The ultimate baseline for comparison is the passive return of the S&P 500. Over a standard 5 to 7 year window, that passive index typically returns between 90 and 118%. This graph plots the passive baseline, climbing steadily to a 118% gain. Failing to eclipse this threshold means mathematically underperforming. Compare that to the retail trader's portfolio: high volatility, deep drawdowns, and a failure to track upward. Pushing buttons and participating in the market does not generate returns. Extracting true alpha requires a structural, mathematical advantage over passive indexing. When faced with early losses, most retail traders follow a predictable pattern. They abandon models to hop strategies, they overtrade to recoup losses, and average down into failing positions. The trading education industry diagnoses these erratic actions as a failure of psychology or a lack of discipline. But those diagnoses misidentify the problem. Emotional turbulence is a symptom. The root cause of almost all erratic market behavior is the total absence of a mathematically verified positive statistical edge. Applying strict psychological discipline to a system with negative statistical expectation will not reverse your losses. It will simply drain your capital with maximum efficiency. Consider a basic probability model using a weighted coin toss. In scenario A, every time the coin lands on heads, you win $2. On tails, you lose $1. That positive asymmetric payout makes the decision to take the bet completely frictionless. You will flip that coin as many times as physical physics allows. Financial markets operate on the same logic, but your win rate is rarely a clean 50%. This equation is the expectancy formula. Let's run a live sample. Assume you have a system with a 70% win rate and an average gain of $80. Your losing rate is 30%, and your average loss is $100. Notice that the average loss is actually larger than the average gain. Yet when you run the calculation, you still generate a positive expectancy of $26 per trade. You do not need to master your emotions. You need a positive expectancy, verified over a large sample size. The math eliminates the fear. Moving from abstract calculations to the live market exposes the flaw in discretionary trading. Take a standard momentum breakout. This candlestick chart shows a stock entering a sharp uptrend. The price jumps 50%. Without a predefined exit target, greed takes over. The trader holds the position, waiting for around 100% return. The market eventually reverts. A heavy sequence of selling drags the price back down to the exact entry point, entirely erasing the open profit. Trapped in a losing trade, the trader panics and liquidates the position out of sheer fear, effectively selling at the absolute bottom of the retracement. Without quantitative, algorithmic rules dictating exact entry and exit criteria, a trader relies entirely on reactive impulses. That reaction guarantees poor execution and destroys any statistical advantage. Even with an edge, there is a structural requirement for success. Institutional firms do not view risk management as fear mitigation. They view it as variance survival. Look at this split-screen ledger. We have Trader A and Trader B. Both possess $10,000 in capital, and both are executing the exact same system with a 70% win rate. Their execution is where the math diverges. Trader A risks a massive 50% of their account, or $5,000 per trade. Trader B risks a highly conservative 1%, or $100. Both traders immediately encounter standard market variance, 3 consecutive losing trades. Trader A loses $5,000 on the first trade and $5,000 on the second. Their account drops to zero. They suffer a ruin event before the system's 70% win rate ever has time to express itself. Trader B loses $300. Their capital base remains intact. They continue executing the strategy, hit the subsequent 7 winning trades, and secure a net profit of $400. Position sizing is the mathematics of survival. If your risk parameters do not allow you to survive the inevitable drawdowns, your positive expectation is entirely worthless. Operating a single system with positive expectation will put a trader in the top 5% of market participants, but it leaves that portfolio entirely exposed to macroeconomic shifts. Look at the reaction of these investors as the Dow ticker collapses. Broader economic shocks instantly invert market behavior, rendering previously reliable strategies unprofitable. In 2023, highly optimized trend-following systems hit choppy sideways markets and suffered severe drawdowns, frequently shedding 19% of their value. The institutional defense against this volatility drag is regime agnosticism. This requires deploying multiple, completely uncorrelated trading systems simultaneously. When a trend-following system bleeds capital in a tight market, a mean reversion strategy activates. It thrives on that exact chop, capturing alpha that cushions losses. These competing models offset each other's weaknesses. The result is a single, smoothed aggregate equity curve continuously scaling higher. Top-tier institutional-grade performance demands an architecture built to extract capital from all market environments, regardless of current economic conditions. This entire methodology condenses down into a strict three-pillar diagnostic checklist. Pillar 1, positive expectancy. If historical backtesting does not yield a positive mathematical edge, you halt operations immediately. Pillar 2, strict position sizing. Your per-trade risk must be mathematically capped to guarantee the portfolio can survive variance and consecutive drawdowns. Pillar 3, flawless execution. Discipline is not a psychological abstract. It is the mechanical ability to follow the exact parameters of the first two pillars without deviation. On this chart of the March 2020 market crash, we see a massive black swan event. To a well-constructed, multi-system portfolio, even a crash of this magnitude is reduced to an observable, survivable data point. Profitable trading is not an exercise in predicting the future. It is the strict, unyielding execution of a verified statistical edge.